Okay, everybody, it's me, Gregory Mannarino. It is Sunday, November 13th, 2022. And this, my lovely friends, is my newest segment of Markets A Look Ahead. Let me start off with this. It seems like a lot of you, rightly so, follow the work of Michael Pinto. Michael's one of my best friends. The truth, the guy is smart, and he is someone you should definitely pay attention to. So I'm checking my email box, and it looks like some of you have been taken back from what he said recently was that the stock market has between 30 and 60% more to fall from where we are. Well, let me just say this right off the bat. Those targets are about correct. However, all of this is dependent 100% on what happens in this debt market. Period. And you all know that. Look, nobody, I don't care how smart you are, who you are, whatever it might be, can look at the stock market as an entity among itself. The stock market itself, people, is a derivative. You know that if you've been covering this blog. The stock market derives value. Period. The end. From action in the debt market. This should be as clear can be to those of you who follow this blog. Did you watch the recent action here with regard to the debt market, the 10-year yield and the US dollar, and see how the stock market has responded? We had a 36 basis point drop in the 10-year yield last week, and the US dollar fell off of a cliff on a relative strength basis. And what did the stock market do? Boom! We're talking about, skyrocketing higher. So, look, you and I don't have to guess. I know that some of you got shook up about what Michael said. And look, I've said that I want you to take away something from this video if you haven't heard it before. I have said that a full-on implosion in the debt market, which is going to occur. And what does that mean? A massive sell-off in the debt market, rates spiking in an uncontrolled fashion is going to cause stock markets around the world to free fall like you can't possibly believe. I've said an 80 to an 85% drop in the S&P 500 off its all-time high. We're 20% off of a record right now. That's it. 20%, it's really not bad in this environment of everything you can think of, but that's twisted upside down, backwards, and sideways. So, what Michael's talking about here, again, in my view, and I could be wrong on this, he's watching the debt market, believe me, just as you are, just as I am. And he realizes clearly that this whole thing hinges on action in the debt market. And currency as well, people, is part of it. It's all part of the same mechanism. Currency, these are units of debt, part of the debt market as well. So by again, understanding the dynamics here, you and I are clear as to what's going to happen. And we have the MMRI, Mannarino Market Risk Indicator. Did you watch this? Last week, the MMRI, fell off a cliff. It's unbelievable. Ever since the MMRI crossed 300, we watched an incredible turn of events, an incredible scenario play out. The day that the MMRI crossed 300, Nick the Pig got floated out. The Fed whisperer, and then right up his wazoo, you had Fed, what the freak is her name? One freaking freak Fed president came out to back up what he's saying, and the market took off. Look, right now, even though we have watched a pretty incredible phenomenon occur here in the debt market with the 10-year yield falling off of a cliff. 36 basis points in one day, it's historic. And the dollar nosediving. Okay, what's going on here? Have they fixed the problem of liquidity? Not even close. Not even close. The global debt market is illiquid. These gyrations that we have been seeing here in the global debt market, global bonds selling off and then getting bought and then selling off and then getting bought here, this yo-yo action here with the 10-year. You think these are signs of stability? No. Clearly you understand that if you've been following this blog. These are absolute signs that the debt market is unstable. And central banks, what are central banks going to do? A couple of things, people. Number one, the reverse repo program. It's the most simple thing in the world to understand. A lot of you write to me, hey, Greg, what is it? What is it? It's just institutions passing back and forth between each other overnight, trillions of dollars. They're just moving it back and forth. Why are they doing this? What's the mystery? What's the secret here? Okay, guess what? The secret is in our face. They're trying to trick the system, as you all know, into thinking it's more liquid. And central banks are going to do something else that I believe most of you are aware of. I don't want to cover that. What do we know is happening right now with no end in sight, going on unabated, and it will not stop? Exactly. The central banks are going to continue to inflate the global money supply on an unprecedented scale. As a matter of fact, we haven't seen anything yet. Central banks are going to continue to inflate the global money supply faster than ever. This mechanism here is obviously, you don't need even 1/10 of a fraction of a functioning brain cell to realize that this is massively inflationary. The more they dilute the global money supply, the higher inflation is going to go. The reason why we have seen the global bond yields crater last week and the US dollar fall off a cliff on a relative basis, because on speculation here that central banks, all of them, because they don't coordinate. You know how you can be certain that central banks don't coordinate their action? Because Yellowstone Powell said it. And if Yellowstone Powell is telling you, went out of his way to tell you that central banks don't coordinate, well, you can rest assured they certainly do coordinate. They talk, they coordinate, and they're going to fulfill their end game. There's no doubt about it. And part of that end game, a key element of that end game, is to continue to inflate. That means you're going to see the global money supply balloon faster. Inflation will continue to rise. Again, what has been going on for months and months and months? What? Central bank's been raising rates. Oh yeah, they're really serious about it. You know how they're serious about taming inflation? Because they've been raising rates for months and it hasn't done a damn thing. As a matter of fact, the inflation report we just got, this miraculously fantastic inflation report that we got last week, well, what did it say? Inflation continues to rise. It just happened to miss forecasts of the retarded economists, and who are always wrong, and the market, got all orgasmic over it. So here's the situation. Looking forward here, okay. Come December, I am 99% certain that the Federal Reserve is going to raise rates 50 basis points, and this is going to get followed up by the ECB. I can't see it going another way at this time. And then don't listen to Greg Mannarino. Listen to the Wall Street super banks who are saying that come next year early, central banks are going to pause. They're going to stop. This is massively bullish for the stock market, although all of us, are going to continue to get crushed by surging inflation because central banks are going to continue to inflate the money supply. But no one's talking about it, people. Look, how many months ago, if you've been following this blog, did we cover right here that if central banks really wanted to fight inflation, they would stabilize the currency? And the silence here is deafening. Not a peep, not a word from a single mainstream media outlet. I don't know how many alternative media outlets or YouTubers have been covering that this is not a rate issue. It's never been a rate issue, and you know that. This is all about a currency free fall around the world, and central banks are continuing to push it. They're sucking the purchasing power out of the currencies by design. By design, all right? What else do we hear from Wall Street super banks? Silver is a fantastic buy right now. Gold is going much higher. Duh. Of course it is. Look, I don't know another way, a better way to bet against the debt, to become your own central bank, than holding these things, Silver, my favorite asset of all time. You all know that. Looking over at cryptocurrencies right now, they're getting hit pretty good. This whole FTX debacle here going on here, it's not good. It doesn't look very good for the crypto space right now. we will keep our eyes on this moving forward, people. Look, every single one of you is entitled to your own perspective on it. You know mine. I'm not going to deviate from this at this particular point. I just like the idea of a non-central bank issued mode of transaction. I really do. Central banks, you all know my take on this too, are cursed upon the earth. They are going out of their way to destroy the global economy and the financial system to issue in a new one. And their new system is going to be some type of crypto-based system. You know that, right? I hope you do. Absolutely. They want control. They want to know what you're doing, when you're doing it. They want to know if you're lending your friend a nickel, a dime, a dollar, and they're going to be able to track everything, every single transaction. Again, we know how this is going to play out, you and I. It's very, very simple. Debt market implosion. It's going to change the financial landscape of the world. It's going to wipe out a vast portion of the global population. A resource issue on a biblical level is going to occur. And this is being pushed forward as central banks fulfill their endgame to be the lenders and buyers of last resort. Anyway, you all know all this if you've been following my blog. You know, I was writing a few things down here this morning. I just wanted to make sure I covered all this. Yeah, I pretty much did. Listen for the narrative change. Have you been paying any attention to that? Oh, they're on it all right. Oh, inflation's turning a corner. Oh, it's going to get better. Oh, central banks, they're going to start easing back from their aggressive stance on rate hikes. This is designed to do one thing. It's a distraction mechanism yet again. Look here. Don't look here. They're going to try to push up the stock market as high as they possibly can. Listen, you know this. If they continue to give the illusion here of stability in the debt market and the U.S. dollar, I've been telling you this for months and months, continues to weaken here, the stock market's going much, much higher. Okay. With regard to Michael Pinto, and a lot of you, I mean, I can't tell you how many of you wrote to me this morning. I'm looking at it. Great, what about Michael Pinto? What about Michael Pinto? Michael Pinto, great guy, smart guy. And he's not wrong. Okay, we are going to get this, 30 to 60% drop is what he said. But I'm telling you, an 80 to an 85% drop off the all-time high is going to happen. But again, it's not just by looking at this grossly overvalued, twisted, upside-down stock market. It doesn't matter. None of that matters. Everything is dependent on the debt market. Everything. So when you hear Michael Pinto or any other guy out there who understand what's going on, Michael clearly does, okay? And they're telling you these kind of things, understand, make it simple for yourself, realizing that stock market is not an independent entity. Okay, it's getting its value from the debt market. By following the debt market, by looking at the driver here, very, very easy to understand where we're going. If risk in this market is dropping, and you can follow this by looking at the MMRI, it's just free to everybody on this planet. I don't charge a nickel, a dime, or anything for it. There's a link in the description of this video. By following risk, and that's what the MMRI does. It looks at the debt market, the benchmark rate, the 10-year yield, and the U.S. dollar. A cute little equation comes up with a number. And there's even a chart there for you now. We don't have to guess, you and I. If we see risk rising, again, we crossed 300, what happened? All hell broke loose. They flowed out Nick the Pig, Mary Dolly, that was her name, up the back door here, and and then all of a sudden things turned around. If they manage to manage risk, either by faking liquidity in the debt market, by jawboning it, the stock market's going higher. The dollar's going to play a role here too, the relative strength of the dollar. And it's all summed up in the MMRI. Anyway, you all know this already, people. I don't know what else to say. So I covered a bunch of stuff with you. I think we have a good perspective on what's happening. So let's just look forward to next week here. Very, very simple. If we see stabilization here in the MMRI, in the 10-year yield, the dollar remains weak on a relative basis, where do you think the stock market's going? Huh? Yeah, pretty simple. Of course, it's going to go higher. If, in fact, the MMRI shows, hey, guess what, guys and girls? Risk is rising. Dollar is resuming its knee-jerk higher. This flight to safety. Well, where's the stock market going? It's going lower. We don't have to guess, people. And that's the beauty of this whole thing. I work diligently to make this as simple for all of you that I possibly can. And I would like to think I'm doing a good job. And I don't know. I'd like to hear from you about that. All right, look, I'm going to end this video. It's going to be a great week. We'll see how this plays out. And I'll see all of you in the morning. Have a great rest of your day. And, well, that's all.